Thursday, August 9th, 2023, morning market. Morning had opened already. I mean, the market had opened already. I have to say, I was recording for an hour. I forgot to say the start recording button. Oh my God. So, yes, we're going to move fast today. I actually went for talk for over an hour at around, so it is what it is. So I ran out the Wix is, I was just ending the talk. Now I was going to do it again, but that's fine. I enjoy doing this anyway. So the VIX is a little elevated level than previous 2 months. So and I was looking at QQQs before it opens. I had a potential force hammer, but right now I don't. Right now, yesterday it gave me a false hammer, but on the QQQ, and now it's doing its thing. So do I have a trade to that? The question again is, so is the down DJI as a hammer in that sense, bounce over 21 days, right? Hugging that nicely, but it looks like it might be an inside bar day, not the spiders. Spiders have given me a doji star. So I was actually going through the list of looking for trade. Right? That's a hammer right here, but it came off what? Look at this deep blue line, right? The problem with this guy is below 200 days moving average. Red line is my 200 days moving average. That means there's more seller than buyers. That's what it's telling me technically. So immediately, even if I wanted to take this trade, it would knock a good 5 to 10% of maximum potential profit, right, on this trade if I take on the long side. If I want to take a trade on this, do I want to take a trade? Not right now, not yet. Right. Other guys have potentials. So where's my red line? I mean, these guys all below, right? If I don't see the red line in here, that means it's either above or below. And this guy is definitely below. That is a regional banking. Looks like they're making a recovery after the March drop. Silicon Valley Bank blew up earlier this year. And then look at the financials, right? The energies, and so energy trying to make new high, breaking up. So let's go back to PKX, the brokerage. Yeah, that's a potential trade right there, actually. But you have to know it's below 200 days moving average. Your maximum profit potential will be less, and not only that, it's a weaker trade, and you must have time working for you if it's a weaker trade. If it's a strong trade, you might go in your way, you might close it within a few days and take your profit. A weaker trade can take 2 weeks, 3 weeks. So typically I sell options 4 weeks to 6 weeks out to expiration. Remember, option pricing have 3 important factors. That's strike price, and the volatility, underlying volatility, and time to expiration. So this is an important part of the premium of the options. Okay, let's look at gold. There's nothing going on. All right, so first thing I want to look for false hammer. I look for breakout, right, and then I look for potential reversal. Right? These are the 3 major type of trades, and they all have specific setup that I'm looking for. I want the technicals all lined up, right? And then, of course, I want to know the fundamentals. After I open the trade, or even before open trade, I would type and look through the fundamentals. But a lot of time during the way the market's moving, I see a trade, I would take it and then go back and look at the fundamentals. Because all price action reflect the fundamentals, all get reflected back in the price action. What does that mean? Well, basically, if you're a long-term investor, long-term stockholder, like Warren Buffett, fundamentals everything. They don't care about how the market, they don't care about the economy as much. They don't care even about where the technicals are. If it's a good company that will make money over time, you want to own it. Right? That's investing. Right? That's fundamental analysis. Right? That's the basic of that. Right? You buy a company that will make money over time. Right? We always say stock is 6 months ahead forward looking. Right? When you buy stock, what do you really buy? You buy the future earnings. That's what you're buying stock. Right? You don't buy, the debt. You buy then that's bonds. Right? So what you actually own the company. Why you want to own a company? Because you think you have profit making potentials. That's why you own the company. When you buy a stock, you bought a piece of it. However small, however big piece of it, you own it. Alright. So in that sense, you're buying its future earnings. That's fun, and you can use fundamental analysis. You look at all the fundamental numbers, and you can deduct and make projection. Is it going to stay in the market? Is it going to continue forward? And is the product continue to sell? Or is this product or service continue to sell? Continue to turn a profit for the company? And those numbers actually, when you investor buy and sell the stock, they determine the fair market price of the stock every day, and so the fundamental get reflected back into the technicals, into the pricing. And this what technical analysis is that's why I say we don't make projection on using technicals. You can see what had happened, what had taken place, what are the buyers and sellers are doing, and come to a fair market price on that time, on that point in time, giving all the information available on the underlying. That's technical analysis. So I don't use technical analysis to make predictions. But however, things that are already set in motion tends to continue to move in that direction of the motion, right? So kind of like Newton's law, and that's what trend following is, and that's why I'm a trend follower. In that sense, technically, when a trend is continuing in that established in that direction, chances are it will go in that direction, continue to move in that direction until the fundamental otherwise, right? The external factors or the fundamental factor changes, right? And that being reflected every second, every minute, right? News that comes out that can affect it, right? So like, look at this, Apple, right? Been on an uptrend, nice uptrend all these time, but right now, right after this earning, boom, it decided to drop. So that fundamental change basically, and get reflected back in the price action. So I want to add this mark telling me that, so I know the fundamentals changed and gave me this picture. It get right through 21 days moving, it got right through 50 days moving average. It broke all the way back down here. Now yesterday, doji stock, not a false hammer. If it's give me a long tail or go below, because inside bar, so it's an indecision day, so it might still have something. Right? But if you look at the MACD, moving average convergence, divergent convergence, the peak was coming off. Look at the peak, right? Making new high, right? That was coming off, and you have this more dramatic retracement right here. You make new high, but look at the peak, right? On this bar, new high, but if a long tails, so people are taking profit basically, so the momentum's dying off. That's become a reversal, and then the next one, try again, not even making new high above this tail, but it flattened out. So definitely when the news come out bad, the buyer's going to step away and the seller's going to come in, and so Apple down, so the stock down. And that's exactly what happened. Right now you see this two line is widening, have been widening. Yeah, so that's not a buying time yet. You don't want to do that. Even if you give me a false hammer, the other technicals that's not lined up. Right? False hammer is only one of the most important technicals that I will look for. I heavily weighted on the setup, but I have to look at the MACD. I have to look at how far away, how big is the divergence. Right now, no. Yeah, so this, I took a reversal trade on this. This is beautiful, right? So this, use MACD for reversal. Right? Yeah. This is to look for reversal trade, but you have to look at other factors too. Just MACD alone is not sufficient. Yeah. The better trade was after the earnings, sell it. That was the better trade. And then right now, you may have a short-term retracement and even go below. I don't like to trade through earnings in actuality, especially on options, because you can do this gap stuff like that. If you on the wrong direction, wow, it's gonna hurt. This is why it's so important that you want to define loss You want to do a vertical, you do a spread on option, never go naked. Especially calls. Never do a naked call. Because guess what? Hey, tomorrow, maybe Apple decide to go to $2 million a share. Oh my God. Alright. Market open. Alright. Short the call, you short the call. Naked call. Alright, that means if you go to the moon, then you're gonna pay all the way in between. Alright, so don't ever do naked calls. Alright, even put in the beginning, if you're a new trader, new investor, don't do naked put, please. Alright. Because you stand to lose all the way to zero. So right now, $178 on, say it's a $200 stock, you can lose $200 stock times 100 because this option contract is 100 stock. Such as one share, one contract is 100 underlying stock. Right? So 200 times 100 is a lot of money, right? For some people may not, but depends on risk tolerance. But don't why take the risk? Do a spread. Do a $5 spread, $10 spread, $1 spread. Right? Look at the risk reward. That's most important. Right now, a low volatile environment, a 1-to-4 ratio. For every dollar, you stand to gain your risk $4 in that sense because we're doing a high probability trade. So the trade-off is you lose a lot more than you win. Everything is priced in. There's no free lunch in that sense. But 1-to-4 is pretty average normal in this environment, low volatile environment. If I get 1-to-3, that's great. Sometimes 1-to-6, if the trade is working really well, I mean, the setup is really well, hey, I take a little bit more risk. That doesn't matter because chances are I can get out early and take profit early in that sense. But that's no free lunch, right? So look at the risk reward, but don't do naked. Don't sell naked call, don't sell naked put, right? Until you're much more experienced. But even you're very experienced, never go naked call. Go naked put because it's still limit loss because it just go to zero, that's it. But if you do naked call, you sell a naked call, wow, it goes to millions and millions, 100 millions tomorrow, right? Who knows? Yes, it's a I don't know, 1,000 standard deviation event that possibly happen, but if that doesn't happen, you crush forever, basically, right? So you want to bracket that loss. You want to limit your loss. You always have defined loss. That way, you know how much you gain, how much you stand to lose, and the most is, hey, you lose that, but it's limited, it's defined. Right? So don't do unlimited loss. Yeah, very important, very important. This is option 101. Right? Yeah, never sell naked call. Never ever. Naked put, situational. Okay, you want to do spread, but never ever naked call. Okay, let's move on. Apple with this guy. Actually, I looked through it earlier an hour ago, but I didn't hit the recording button, so it didn't record. Unfortunately, but I was just going through the whole list of looking for trade, but is the market going to come off and stuff like that, in that sense, right? And right here, again, I talked about it already. This is a reversal signal, right? Doji star, right? I see a doji star. I see my MACD, right, coming off low peak while the market make new high. That's a reversal right here. Next bar, yeah, right. But because if on back of an uptrend, right, the reversal is very difficult. You have to give it a lot more time, a lot more patience in this sense, right? Because if I saw on the next bar here, now you trace all the way back, right? Do a 5-day down move and then we trace back. That's what difficulties in reversal is, that it takes longer time to develop in actuality. Instead of going with the market, going with the instrument, going with the momentum direction, right? But definitely momentum die off. That's why you have to reversal. And this, yeah, that doji star. Now, very aggressive trader, right, would have sold this by around the end of the day, right? If stay at this level at the end of the day, I don't know, half hour before close, 15 minutes before close, unless something really dramatic happen, it's going to close at doji star. Then you sold, right, a 20 delta call spread, again, never naked, 20 delta call spread, and the next day you're in the money, you capture all these. This is what you need to do if you trade reversal. You need to be in front, right? Even where I'm daily buy, end of day trader, but you trade close to end of day when the formation happens on the reversal, so you can capture this drop. Right, there's a perfect prime example. What you need to do, you need to be there. You need to take the trade at the end of the day as the formation happen before the market close. Right, 15 minutes, 10 minutes, right, that no major signals are coming in, no major news are coming in, then chances are it's going to close the doji style. You want to open that position right here, and then you capture all this profit. Right. This is how you trade reversal. You want the technical indicators, right? You want the candlestick, and you have to be there to do a reversal trade to give you the best probability. Basically, you got it in front of the screen at the end of the day, before the market close, if you are going to take and sell for this reversal. So very important, right? And you look at volume spike, but you have to be there. Let's add this. Right? And importantly, trade before trade, right? Before market closes as the candlestick formation takes place. This is very important. This is how you trade reversals. So here's the rules. And it's very clear that we want to stick with these rules and give you the best probability of the trade working out. Right? After you short, sell the call spread here, wow. And even right now, you know, but if you wait to the next day, it's very difficult. So reversal, that's how I would do it. Right? I want the technicals lined up, and then I have to be there as the formation took place before the market close, right? 5 minutes, 10 minutes. And if there's volume in that option, then you can trade closer to like 5 minutes before, so you get it executed. The other parties get it executed, right? So anywhere 15 minutes or so, you want to put that order in, and then hopefully nothing dramatic happen within that 10-15 minutes, and then close with that candlestick formation. Right. Very important. Little things, but they all add up to your winning chances, winning potential. Right. So like this guy went through already, so Q-com was marked. Yeah, but that's nothing. Actually, I should take this out. Yeah. IPM. Yeah, nice uptrend. No signs of reversal. Yeah, no signs of a. That's a nice breakout, right? MCAT make new high. Right, the peak stay up here, and looking for a false hammer, looking for a chance to get in. Right, first move. Right, above 200 days moving average, come back down, fight at the 200-day moving average, and then eventually continue upward, and then break out again here. All right, broke out. Yeah. So might be a trade coming up on this guy. Who knows? Right? So also there's I marked this guy. Yeah, nice consolidation around here. Look for false hammer, penetrate through, come back. Yeah. Now let's go up sideways. Right. Come down a little and then go up. That's ideal. Right. So this guy. Now we have with this consolidation level. Right here. I'm just marking as consolidation. Nice area. And see what it's gonna do. Okay. Mark 424. Oh, it broke down. That's why. That's probably why I marked it. Huh? Yeah. Ow. Came all the way back down. So. Yeah. See, very clear. Make new high, but your MACD does not. Potential reversal signals. So yeah, very clear. Yeah, that's why I always have my MACD to see the momentum. MACD tell me the momentum. So as the momentum compress and dies off, and that tell me what a likely scenario that how the stock might trade out, right? So yeah, come momentum trade, momentum up, breakout, right? And then sideways and come off a little, right? So maybe a trade coming, breaking above 200 days moving average, right? Yeah, let's see. That might be a trade coming on this guy. That's why it's marked. V, a little bit more weaker than the other one. Yeah, just big bar or something. Yeah, nah, just have nothing now. Right. So I was looking through all these earlier, and then JP Morgan have a hugging the 21 days moving average line nicely, fighting. So we'll see. Schwab too. I'm looking at a little bit weaker than JP Morgan, but it's fighting at 200 moving average line now. Okay, so we'll see what we want to do. Is our market potential? Pinterest was marked. You have this up, down, sideways, whatever this. Yeah, so I marked it right at this breakout level. I would prefer if this is the better level, right? Because the next level is here. In actuality, the next level that we'll aim for is here. So I want to mark it and see how it goes. See what I want to do. Right? See if that's a sell. Right? G having a long-term uptrend, so we'll see. It's bouncing off. Right? Maybe bounce around sideways. Sideways is fine too. Right? Because I'm option seller, so I collect premium every day. If it goes up, I close out the trade, make money sooner. If it goes sideways, take a little bit longer holding. Right? If it goes down a little, that's fine. I always say, here's the thing: when you open a trade, that's the thing. The price that you bought the stock or open it, right? Or open your option trade, right? The strike price, right? And then you have the profit target and your stop loss. Right? For any given scenario, on my option trade, I have 5 scenarios. You can go sideways. If it goes sideways, that's fine. It take me longer holding and I collecting money every day because I'm an option seller. So I collect the premium a little bit every day. If it go up a little, I may close out a little early. Right, 50% of a maximum profit potential. I will take the profit. Right. If it drift a little, right, it doesn't hit my strike price, that's fine. I have just even hold it longer. Right. So that's 3 scenario. Sideways, up a little, down a little. Right. The 4th scenario, spikes up, make new high. Oh, then I get to close out the trade even earlier. Take profit early. Only the 5th scenario is it goes down, right, and then it went for my strike price. But if I still have time, premium left, hey, that's fine. It might work. I just need a little up move, and I will neutralize trade and take a small losses. Right. The only worst scenario is to go all the way down, the 6th scenario. Outside of the 5 scenario, right, I won't lose much, and most of the 5 scenario, only 1 scenario I would lose a little. Right? Only the 6th scenario now is that it just keeps on dropping. Right? Everything fundamental, everything change. I mean, and I have sent to take the maximum loss, and there's nothing I can do. Right? So we get this way. Out of the 5 scenario, 4 of that, I'm money. 1 of that, I lose a little. Only the 6th one, I will have to take maximum losses. Right? This is the odds on my trade. I have such good probability of making money. Right? In that sense. Now it's all in the setup. Right? People think about at least the 3 things I talk about when you open the trade. But for me, I open the trade, I've thought about all potential scenarios already. Right? For every given scenario, I know what I would do, and what I need to do, or what I don't need to do. And most of the time, I'm just let it work out and let it go sideways. And at some point, I take profit. Typically, I don't want to wait to hold the whole duration to expiration. No, I don't want to do that. I want to close out my trade 2 weeks before expiration. That's ideal. Okay, that's very important to develop the mindset of possible scenario and what you would do, what you want to do, what you need to do, what you don't need to do. On every trade, you want that. You want to have that visions. Right? And that make you an experienced investor, experienced trader. And it applies to everything you do in life. You want to see for all the possible outcome. And then you can walk yourself through giving this outcome, what I need to do, I don't need to do, right? That is a very important skill set to apply to life too, right? So everything in trading actually reflect back in your life. You can utilize all this skill set. Right? So that's why they say trading is very personal. Given what type of personality you are, you will take the type of trade of your personality. Right? The style, the strategy have to, and the risk reward have to fit your personality to work out. Right? You can tell. And like as I get older now, I have much less risk tolerance. Even there's a lot of good trades I see. Back in my younger days, I would definitely take all. I would have all these trades open already actually, and now we assess the situation. I have time to open the trade and then assess and then look at the fundamentals. The market's moving, trades moving, and I see this. That's a good point to enter. I'll open the trade first and then look at the fundamental, do the analyze. You have to do it a lot of time. After certain years, you can do this on the fly. It becomes automatic. Okay, this is a trade I need to take right now, and then I go back to do deep analysis afterward. Right. And if it's a good setup, you can see it. You say, okay, this is a trade I need to take. I just open it, right, and then I take my time and slowly evaluate. What kind of scenario my outcome is, and what do I need to do? Wow. If open trade that, oh gosh, this I went the wrong direction, yeah, close it. Pay a few buck, right, to the market maker. Right, close it, right? You lose a few buck. That's all. Right, but if it's moving, right, you don't want to miss the opportunity. Now, you only do that if you're an experienced trader. Don't do that. Oh, open the trade first and then do it analysis. No. Don't do that. That's like you have, a few good years of actively engaging the market. Then yeah. Right now, you want to see the setup and you want to see the possible outcome. And then, when everything is all covered, then you open the trade. Okay? Yeah. So, let's move on. Yeah. So, let's move on to the one that I flagged because the other one I've looked through already. So, no point of clicking through everyone. But maybe there's something. But this trend is a much weaker trend. But it did a breakout above 200 days moving average, and it might bounce off these technical levels. So I marked that of time to this guy Riot. Finally moved back about 200 day moving average, and then going sideways. And then there's momentum. Nice. 2 weeks every day up, right like that. Momentum I move. Now it's coming off, and then it give me a false hammer. Right, that's a trade right here. That's a trade right there. Actually, well, if I miss it, if I'm aggressive, I'll open the trade right now to put it down. Tony Delta probably over here, a little bit low. Maybe a 13 or 14. All right, sell 13 or 14. Put options. That's the trade right here. That's the trade right here. Yeah. I'm trying to lure myself to open this trade, but it's August. I'm just too lazy. I have two pretty good trade already. Yeah, Charlie. Yeah, but that's a false hammer, I would say. Not as powerful because upside way up is not one-way continuation uptrend, right? But if you line up to give up, it's over 85% when everything line up. There's a 75% chance of this trade will work out. Yeah, Charlie. And yeah, in that sense, 75% right now. Well, everything changed tomorrow, maybe become 70%, 60%, right? Who knows, right? But right now it's 75% of making that 50% of a maximum profit potential. Percentage of making half of maximum profit potential. That's my percentage number I construct in my head of every trade. When I talk about the winning percentage, it is what I'm talking about. The option trade, 50%, half of the maximum profit potential of the option trade. Okay, let's move on. All right, that's another one to mark. Yeah, pretty much upside way up again, almost the same, right? But this guy is a different animal. Right, so we'll see these and then all the way down. Home Depot might have something, right? Uptrend and then bounce off this 25 days moving. 21 days moving average white line, right? A little false hammer, but we'll see. These guys are not really in play. Right, and this is what I meant. When not in play, when it come off, right, it came off much deeper. It go into this level, right, this previous breakout level, right, this peak, right? Came all the way back down, and then give it this horse hammer, right? Yeah. So these are like 70%. I would say 75%. If I open these two trades right now, anywhere from 65 to 75% of probability of 50% maximum profit potential in that sense. But yeah, it's August. I'm a little lazy. This is the first one to get in. If the MACD moving average, see these two lines is further wide apart as it reverse and it start narrowing again, yeah, that's might be another chance to get in actually. But yeah, I'm not doing that this week. This month I'm just taking a step back, relaxing for the month. So yeah, it's a neo trade. Yeah, so it's working out again. So 6 profit scenario every time I open a trade. It goes sideways. Eventually, so every day I will pick up a little bit more premium because I sold the put, right? So I mean money. It goes up a little. I may get to close out the trade early because it reached 50% of my maximum profit potential. That's my rules to get out. It go down a little. Alright, so that take me longer holding period, maybe a week or 2 weeks before then I close out. Alright, and take the smaller gain. Alright, goes up a lot. Oh, then ride the trade. Maybe even take it all the way to the end, get the maximum profit because it's really working out. Collapse down through my strike price. Now that's why I'm losing money, right? But I still have time. It comes down. If it need to bounce up a little, then I will take my small losses. Alright, I can go sell the trade at a loss, small loss, not maximum loss. Only the 6 scenario that it go through my strike price, go through all the way through my vertical price, and then continue downward. Then that scenario I will end up taking maximum loss. This is why it's so important. I have defined risk. I know my risk reward ratios. Alright. So typically for every dollar I tend to gain, potentially I would lose 4 times $4. Right? So the most I would lose is 4 times maximum profit potential in that trade if it go through, right? But for Neo, it's a different scenario because fundamentally I have a long-term holding. I want to buy this guy and hold for the long term. So if it go through, guess what? I can add another position, turn it down because this is only my first leg. If it comes off, at some point I probably add to this position. I always have 3 legs in. That's how I play this game. When I go in, leg 1, right, it's open. If it comes off more, I find some place. Before the reversal, I open leg 2. If it go through, now if it go through, and I reach all the other fundamental holds for long-term holding, I will again put another $20 down. And sell another put. In that sense, because I own the stock. It is a cash secure put. I want to actually own the stock. So either way, it comes off. I will eventually, hey, I buy the whole 100 shares. That's great. If it goes up, so this trade, this is what I call a 99% win. Why 1%, not 100%? Because if every other fundamental trend upside down, all the numbers are fake, and say, oh, this is all, this is a make-believe game, no company actually exists, Neo is all BS, right? Or the stock collapse to 0. Right? So that's still that very low, however low probability, that's still the probability that this whole thing goes to 0, right? In the sense. But other than that, fundamental wise, I have a long-term investment theme on this guy. I want to own it, I want to own more of it. So it comes off, I will sell more secure put, and I own more stock. That's all of the actual underlying. So this guy is a situation where I want to own long term, and I'm trading around my long term investment thesis. Right? So is this guy, or these 4. I have positioned long term holding on these 4. Okay, so yeah. So these I'm not even really looking at it because hey, I want to own it. So in that case, hey, is when I open the trade, after this momentum move, okay, this is a win. I'm actually making money on these guys already. I'm a long-term holding. And then I'm just trading, adding more position to it and trading options around it and to make a little bit more, which is great. So yeah, so August month, basically, I don't think I'm gonna open really more trade even that unless that's very good setup like Neo and Lee, these 2 stock. Otherwise, yeah, I would see, some decent trade, but they're not really perfectly lined up like the other two for me. So yeah, in that sense. But if it's I'm an active one, I'm actually trying to look for trade or stuff like that. Typically, yeah, and I would take all those trade. I would take probably 2 out of the 3 I was talking about. Yeah, there is still good probability of 50% of maximum profit potential on those option trades on those setups. So yeah, I flag this because it is one of these. Oh my god! So if this up move, we trace the low bounce off the 21 days move, right, and then it pulls up, but wow, something happened. Even before earnings, they decided to sell it down. Wow, this is ugly. This is pretty ugly. Yesterday was you thought it would stop, right? But earning came out yesterday. Earning came out really bad. Fundamental wise, this guy got crushed. Right? So earning came out, and see, this is the problem. Right? Earning comes out, and the whole picture turns around fundamentally. Right? So hey, this could happen. This is the dangers of starting option. You could run into this situation, and you have chances are you're gonna end up taking like some loss. Right? Even you turn the delta away, right? And yeah, these does happen. So even on a nice uptrend, it did this. And I'll start holding. Yeah. So yeah, that's nothing you can predict you can do. It's just that you gotta. That's why it's so important to define your losses, limit the loss. You know how much maximum percent to loss, and it could happen. Right? That's the nature of the game. So if it's 1 to 4 risk reward, you're gonna need 4 trade, positive trade to make the money back. Right? That's the downside of these high probability trades, is that when it goes against you, you pay up a little bit more. You make much larger losses. Right? But hey, it's a fair game. Everything is priced in. There's no free lunch. You want high probability, you can have that, but you got to have stomach for the bigger loss, much bigger loss. That's how it works. Anyway, let's move on. Okay, I marked this guy. Yeah. Came off this. Yeah. Not really much yet. Yeah. So. Woohoo. Yeah. Well, what's this? Oh yeah, it was a market as uptrend and then a potential false hammer, but then see, all right. But what's wrong? The picture is here. What's missing is right here. The MACD. MACD divergence. It make new high on the instrument, but this did not rise to this level, the previous peak. You make lower peak. This is a reversal signal, right? So even I mark this as a loss hammer, it has to be invalidated because of that. That's why I always have a MACD up, right? Because that is my reversal indicator. As the momentum dies off, okay, when they make new high, and the MACD's peak does not went up to the same level, that means this momentum dies off, and then even this give me a Thor's hammer, and it's actually right bounce right off the 50 days moving average. It's so short lived, and then it collapse like that. Wow, there's no way even to make a comeback, no chance. So that's why you want everything to line up before you take the trade. Okay. And this one is a potential trade when it's more smart, because you don't know yet. But as you took this trade as it move and then make new high, and you see the MACD doing this, you're gonna find a point you want to get out already. Matter of fact, I probably get out on this bar. When I see the MACD is like this, I will have to get out on this bar. A good trader will get out on this bar. Take whatever you could before you do one of these. Yes, you have a second chance actually. But if you don't get out on this second chance, wow, it's going to become painful. And then apparently it did. Alright, so This is why I use all my chart always have my MACD comes up with it, so I can see a potential reversal scenario in that sense, right? Now I'm mainly a trend follower. Yeah, that's so give me a best probability trade, best probability of taking 50% of maximum profit. Okay, I always talk about 50% of maximum profit. That will skew my winning trade even more. Yes, I don't ride to take the whole thing, only half of it, but hey, take what can be given to you already. Why ride through the end and leave all the risks out there? I want consistently make money, and that's what I do. I don't ride it to the end. I don't wait till the whole option expiration. They always tell you, yeah, the last week's option expiration, the premium just exponentially decrease were very advantageous for the seller. But volatility can spike because it's so fast, right? I sell options at least 4 to 6 weeks, sometimes 3 weeks, but ideally 4 to 6 weeks of time before expiration. It's very hard to project that far technically. Right? So I'd rather close out early, right? When there's money, and call it a day. And that's how you can build consistent profit is, hey, take profit. Right? Depends on the scenario. Really depends. If it's an uptrend and continue to go up like that, hey, yeah, you can ride longer. But if it's going sideways or slightly down, you want to get a little bit sooner in that sense. Just like Neo and that guy, but Neo and me. But right now, those guys, well, I will see because actually, if it really go against me, I end up owning the stock. That's fine too. I want to buy more of the stock, but ideally, yes, I want to get out early. That would be ideal, right? So you have all these scenarios play out as the market continue to move forward, give you all these signals, all these levels, and tell you what is the market thinking at that point in time, and you determine when you want to get out. In that sense, yeah. So this is why 80% of the option, they say, 80% of the option actually get closed early and expire without even getting exercise. That is as empirical data is a fact that 80% of option doesn't get exercise because people close out early. 1/3 of them close out early. Right? Yeah, 1/3. Some of them hold till the end. Some of them readjust the position, but most of them does not get exercise. Keep that in mind. So that's why they say, yeah, it's advantageous to be selling options and pocket the premium. But you have to understand, it does not mean it expires worthless. 80% of it is actually the 80% comes from they get closed out early. Okay, when they get closed out early, yeah, so it doesn't get exercise. That's what it meant. Well, let's move on. I was looking also through the AI stock, but it was very clear they're coming off. Most of them have these like double top, right? One peak, two peak, double top, and then coming off. All of them is doing that. Most of these, that was a hot sector this beginning of the year. Now this guy even really broke through and came off, right? So yeah, you have a long, nice run, and it's doing retracement. That's what it is. Right? It broke through 21 day, 50 days. Wow, this is getting interesting. So this peak maybe was aiming for, the gunning for. Who knows? But I want to see a little sideways action, a little bias coming in, or where the level stop right now. But right now, nothing to do with these guys yet. Right? So this guy held a little bit better. I marked it, but yeah, it broke through. These today broke through the 50-day, the blue moving average. So yeah, let's move that. Nothing much. AI, okay, up, sideways, right? So this guy might have a play coming up. This guy, oh, I marked it. Yeah, that would have worked out. I didn't play that. Interesting. Okay, up, right? Wave 1, wave 2, I would say. All right, the problem? Here you go. Wait. MACD divergence. No play. Now this is double top, so I would not really call it. It's still, yeah. This guy. Let's take it off. Nothing to watch. And now we're talking about a little bit about these airliners. Nothing much. And then all the way down, Boeing, LMT, and these guys. Yeah. And then retails. This guy just broke through a 200 moving day average, right? So at one point I was actually looking for continuation, bouncing off this, right? Because it did this before. Down, boom, right? Test the 200 moving average and came back down. Okay, right here, went through. Who knows, I might continue that or we might reverse. That's a difficult trade. Difficult to tell, take that off. I'm like, oh, somehow, we bounce off a 200 moving average and then do one of these, but it's not apparent enough for the trend, so let's take that out. Okay, yeah. And then these guys, the high yield and all the income fund ETF, and these are different animals. So yeah, that's about it for the market today, this morning. There's a few interesting trade that could have taken if I'm more aggressive, but this month I have a couple of trade and already again importantly 2 things. The takeaway of today's talk is never sell naked calls, always do verticals. And then, unless you're experienced enough, don't do naked put either. Do a vertical. Always do vertical. Right? When you open the option trade, when you sell options. The other thing is, every time you open trade, right, there's a strike price where you open it at. There is a profit target scenario and the stop loss scenario. Right? For me, I have 6 scenarios every time I open a trade in actuality. And out of the 6, only 1 will result in maximum loss. The rest, right, 4 of them will make me money, 50% of maximum profit. 1 of them will actually ride all the way to maximum profit. 1 of them have to be a little loss. Right? So of the 6 scenarios, there's only 1 that have to take maximum loss. But when I open a trade, I have these scenarios in mind and already know what I need to do, what I don't need to do as the market progress, as the stock move. Right? And I'll envision what it could do and what I would do and what I won't do. Right? And as it play out, right, in one of those possible scenarios, I know what I would do already. So I guess sleep well at night and hey, worst come to worst case scenario, yeah, maximum profit loss, but it's always defined, always limited loss. Right? In that sense, so that's the risk capital I'm willing to put up, right, to gain half a profit I'm willing to gain. In that sense, right? So your profit, my profit is undefined when I open the trade. It depends on the scenario that's going to play out, right? But my loss is always defined, always a defined loss trade. Very important. When you trade stock, when you trade anything, when you do anything in life, always have a limit loss. You know when that, okay, this is where I throw in the towel. Right? Why? Because you can always make a comeback. Right? You always have other trades down the road, and then eventually, right, you can make a comeback. But if an undefined loss, you cannot get back up, and that's it. Right? It's going to take you years psychologically, not just to save the money and pay off the debt, whatever, right? Having the money to come back, but psychologically, you take a hit like that, it's very hard to get back up. Right? So again, define risk trade. Always define your maximum loss. And that will be how much you're willing to lose. Okay, and typically I recommend people 5% your maximum risk capital on every trade. If you're comfortable, 10%. So you have a 10 chance. Right? You got a 10 losers in a row to blow the whole risk capital, and then you start over again. Right? Don't put everything into one trade. Never do that. Never do that. Right? And always have defined risk. Okay. Well, that's it for today. And this time I'm sure you caught it. And I will put this up and I'll see everybody next time. Thanks for watching.